Hey guys, JC Parets here of allstarcharts.com, and welcome to the JC Show. So, when we started doing this about a month ago, they asked me, the good folks at StockCharts TV were like, well, JC, what do you want to do every week? And I'm like, well, why don't we start with something educational, something I probably had to learn the hard way. and then we'll get into the markets, right? Let's talk charts, what's on our radar, what are we looking at, what are we worried about, what are we excited about, etc. And then we'll finish up with some questions. So that's what I'm thinking. I didn't have a lot of questions this week, but we'll get to that shortly. So today's lesson, I was thinking about it this morning, and I didn't even realize I was going to record this today. I was just kind of thinking, and we've had some success over the last, particularly over the last 4 months, more success than we've ever had. And it's, I've learned the hard way, JC, check yourself, right? Check that ego. Yesterday, for example, I was feeling pretty good. I'm like, man, things are going well. And when I get those feelings, I've gotten those feelings in the past. I've been doing this for almost 20 years. And when you get that feeling and you think that maybe you're invincible, I don't think I'm at the point where I think that anymore. I used to back in the day, but even the slightest inclination that, I might be better than others at this, or that I might, I'm really good at this, or I have the secret, I found the secret sauce, or, whatever it might be, check yourself. Check yourself. Again, and it's not just me. I mean, I'm feeling it myself because of some recent success, but really what we want to do is remain balanced. Because what I've had to learn the hard way over many years is that when things are good, it's not as good as you think it is. And when things are bad, it's probably not as bad as you think it is either. So the idea is to stay even-keeled, is to remain balanced. Many years ago, let's call it 2006, 2007 in particular, and 2008 for that matter as well, I remember vividly walking to work every day. I lived 11 blocks, 11 New York City street blocks, so short ones, not the avenues that go across, but the short ones. 11 blocks from my office. So I did that on purpose so that I can be close to the office and be able to work late and all those things. So anyway, I had the same walk in the morning to work, literally right up Park Avenue, and I had the same exact walk back from work every day back down Park Avenue. I lived on 33rd, 34th Street and Park. I lived at 4 Park Avenue back in the day. And old school building. Really, really cool building. It's where Wolfgang's is. I lived on top of Wolfgang's, for those of you who are familiar with New York City. So anyway, I remember sometimes walking back from work being like, wow, I'm the next Warren Buffett. This is fantastic. And then the very next day, I'd be walking home, be like, what am I doing with my life? What am I doing? Like, this is just not the way to live. Everything's falling apart. And then a week later, I got that pop in my step again. Oh yeah, baby, we got this. This is for me. This is what we're doing. And, and then again, I would go back and be like, oh my God, what am I doing the very next day, right? So the swings in emotions were incredibly volatile. And I didn't realize I was doing it right away, but when you're making the exact same walk every day, passing by that same Bank of America, passing by that same deli, every single day, you recognize those emotions. Wow, yesterday when I was walking by this Bank of America ATM, I felt great. Today I feel terrible. The next day you feel great. The next day you feel terrible. The swings were out of control. And there's nothing worse, right? That's just not healthy. So I guess the lesson of the day, and I tell you this anecdote to show you, that's something I had to learn the hard way in recognizing your own behavior. When you're down in the dumps, it's probably not as bad as you think. And when you think things are fantastic, it can't get any better, it's probably true. Probably can't get any better. And you're about to mean revert, right? So check yourself. And I've had this conversation with some really smart friends of mine. A few months back, I was talking with Brian Shannon and Joe Fahmy about this. Guys have been trading for multiple decades. Both of them are older than me and actually have been doing this longer than I have by a few years, but still have been doing it longer than I have. And they have the same thing, when they start getting that feeling that, wow, I'm invincible. Wow, things are going so well. They start trading smaller, right? They start checking themselves. Even if there's no market reasons, even if the market hasn't indicated anything, they start checking themselves, position sizing smaller, tightening stops. And I love that because I didn't know they were going to say that when I asked them the question, but that's exactly what I think you probably should be doing. That's what I'm certainly doing when I catch myself a little too giddy, right? Which I was last night, which I kind of was this morning too. A little giddy. Check yourself, JC. Check yourself. Stay balanced, right? All right, so that's the lesson of the day. Don't get too high. Don't get too low. Try to stay even keeled. All right. What's going to derail this market? I was on a podcast. Check out the podcast, Technical Analysis Radio, on Apple iTunes, Spotify, Overhead, whatever. Is it Overhead? Whatever podcast listener, they're on all of them. So go check it out. I had a chat with Jonathan Krinsky, and one of the things we were talking about, him and I look at the markets in a very similar way. We're both CMTs. We look at it from an intermarket perspective, all of those things, sector rotation, market breadth, momentum, etc. And I'm like, what's going to derail this party? I'm looking at the US dollar personally. I'm thinking, in 2018, when stocks peaked all over the world, not just in the US, but globally, that's when risk peaked in January of 2018. That's when the dollar started to rally. That's when the US dollar bottomed, right? Was that a coincidence? I'm going to go with no. At the time, I may have thought it was a coincidence, right? But last March, when the stock market bottomed, that's when the US dollar peaked. And the dollar has been getting slammed ever since. And stocks, obviously, I don't know if you got the memo, stocks have done very well since the spring last year as the dollar has gotten slammed. So there's no evidence that suggests yet that the dollar's about to rip. But I think we need to be aware that if the dollar does rip, could be a major headwind for equities, for risk assets, right? So that's how I'm looking at that. I'm looking at the US dollar for sure. Let's get into a few other things that we're looking at. Actually, I want to show you what's going on with bonds before we get into the seasonality. So here we're looking at the US Treasury bond market. This is TLT. Notice the support last summer. Notice the support again in November. Notice the support again in December. And then boom, we started out the year with a break. Now, the bond market has been creeping up a little bit. It hasn't made much of a move. I mean, when I say creeping up, I mean like literally creeping up. But I think it's incredibly important to be aware of what could potentially derail this market. What's going to end the party? Who's going to be the RA in the dorms to bust the party and take all our beer, right? That's the question. I think the US dollar could be one of them. Most certainly a bid in US Treasury bonds getting back above all that support. This turning into a nasty failed breakdown and we get a face ripper in bonds. By the way, commercial hedgers have on like crazy long positions, bullish positions in US Treasury bonds. Some of the most aggressively long positions ever. Now, just because commercial hedgers are super long Treasury bonds doesn't mean that bonds are going to go up. In fact, they've been super long Treasury bonds and Treasury bonds keep falling. So let's keep that in mind. But if you're looking for a catalyst to get it going, that positioning between speculators and hedgers is interesting. But putting all that aside, I think the level itself, 155, that's the level. That's the level. So if you start to see a 155 handle in the US Treasury bond market and we hold it, that's most likely happening in an environment that stocks are under pressure. And if stocks are going to be under pressure, this would be a perfectly logical time for that to happen, right? February historically is one of the worst months of the year, and it gets worse on post-election years. Right? So here you can see the seasonality charts going all the way back 70 years. And you can see February is that single month that is sort of the downer during the best 6-month period of the year. Right? Which is November, December, January, February, March, April, and then you've got sell in May and go away. So of these 6 months, this is the lonely soldier that doesn't look so good, right? So from a seasonality perspective, if the market is going to correct, this would be a perfectly logical time for it to occur, right? That single month, that's sort of the downer within that sweet spot. Not to mention, speaking of sweet spots, that the best 3-month period of the year, right? Because everybody's like, well, sell in May and go away, but you have to remember to buy in November, or as Jeff Hirsch says, buy in October and get yourself sober. The reason we say those things is because November, December, January, that 3-month period is the best 3-month period of the year. That's the sweet spot. And stocks have done very well during that sweet spot. So we're ending the best 3-month period, entering a bearish period. Now, we're not just going to blindly short stocks because we're entering a seasonally bearish time of the year. That doesn't make any sense. But I do think it's important to recognize where we are in the cycle. Post-election years in February, going back 70 years, tend to be horrible. For the S&P 500, it's the worst month. For the NASDAQ, it's the worst month. For the Russell 2000 small caps, it's the worst month. And then for the others, obviously, it struggles as well. So something to keep in mind. The Russell 2000 small cap index is hitting the 161.8% extension of the entire 2018 to 2020 bear market. Cyclical bear market, cyclical decline, correction, whatever you want to call it. The 161.8% extension of that move gets us here. Now, does the market care what JC's Fibonacci analysis is? No, right? Are we blindly going to be shorting small caps because we hit this extension? No, right? Should we be aware that we are approaching this level or we've approached this target? Yeah. Would this be a perfectly logical place for small caps to have some sort of correction, some sort of digestion? Sure. Is there any evidence whatsoever that it started? No, right? There isn't any evidence yet. Something I think is worth watching is what's happening globally, right? So here we're looking at the percentage of global markets above their 50-day moving average, which is kind of like a lazy way of saying stocks on a short-term uptrend, right? 200-day moving average, long-term uptrend, 50-day moving average, short-term uptrend, but an interesting gauge nonetheless. So historically, just keep this in mind. Right now, going into yesterday, it dropped to 78% of countries around the world above their 50-day moving average. This has obviously come down quite a bit. It's 83% for developed markets, 74% for emerging markets. Historically, that 70% threshold, when we fall below that, that's a warning. When we're below 40%, that's a big, big problem, right? So from a market breadth standpoint, from a global breadth standpoint, this is one that we absolutely want to watch. And then, by the way, if you want these slides, if you're interested in them at all, feel free to email info@allstarcharts.com and make sure to use the password bubble trouble, info@allstarcharts.com, because if you don't include the password, I give presentations all over the world. You can get some presentation about Indian small caps, or you can get a presentation from 3 months ago. If you want this one in this group of slides, bubble trouble, info@allstarcharts.com. Let's talk about overbought conditions, because if people are like, oh, JC, I can't buy stocks because they're overbought. And my response is, well, how can an overwhelming amount of buying pressure possibly be a bad thing, right? How are so many people wanting to buy? How is that a bad thing, right? You learn in the first day of economics class that if there's more demand than supply, prices are going to go up. And when stocks are overbought, that's evidence that there's more demand than supply. So this is just a great example of the fact that stocks can stay overbought for a long, long time. In fact, the Russell small caps, while I'm saying this, let me just get a quote real quick. While I'm saying this, I believe we are making all-time highs. Yes. As I'm saying this, a little bit after 11 a.m. on the East Coast on the 27th of January of 2021, Russell Microcap Index is making new all-time highs. They got overbought before Thanksgiving. Several months later, here we are, by the way, still overbought, obviously, and we're making new all-time highs, and the uptrend has continued. So when you hear overbought, don't run away from that. That should attract you. Be like, oh, wow, overbought, huh? Solid. Rock and roll. You know, if you think that a stock is in a downtrend and you're seeing overbought conditions, you probably want to reevaluate that thesis. And same way on the other side, right? Stocks and uptrends don't get oversold. Those are characteristics of downtrends, right? They tend, we use a 14-day RSI, and 70 historically is overbought, 30 is oversold, right? It's an oscillator, so it moves from 0 to 100. Getting overbought, getting over 70 is perfectly normal. That's a healthy uptrend. Now, if you think something's in an uptrend and you start seeing oversold conditions, you probably want to reevaluate that thesis, because that's not a characteristic of an uptrend. That's a characteristic. That's not a characteristic of an uptrend. That's a characteristic of a downtrend. So something to be aware of. Obviously, that's not happening here. Russell microcaps. These are the microcaps, by the way. These are the smallest of all of them, making new all-time highs as we speak, have been overbought for several months. Let's talk about emerging markets, right? We've been seeing that strength in emerging markets, rotation on a relative basis. Emerging markets are making 18-month relative highs to the United States. That weaker dollar has helped international markets outperforming. We've talked about this at length. Now let's talk about support and resistance in Freeport-McMoRan, which to me is a bellwether for that whole story. Latin America, base metals, global growth, demand, industrials, like that whole story, Australian dollar, right? That whole story, that risk-on story, that offensive trade story, that the opposite of defensive, right? All of those things, we hit an important level, right? Let's talk about it. Let's look at support a decade ago in Freeport-McMoRan, support again in 2012, support again in 2013, and kaboom, there's the drop. And then the collapse, and then the bigger the collapse, the longer the need for repair, in this case, half a decade, and now we're back to the scene of the crime. This is what we call polarity. These are the polarity principles where former support turns into resistance. The fact that we've seen Freeport-McMoRan coming off this week as we hit this level shouldn't be surprising, but forget about this week. Let's talk about moving forward. Think about the bullish implications of Freeport-McMoRan absorbing all of this overhead supply, this former support, if you will. I don't know how long it's going to take to absorb it. I don't know at all how long it's going to take, right? How long could it take? A couple days, couple weeks, couple quarters, couple years. I don't know, right? But definitely one worth watching. If you see Freeport-McMoRan consistently holding above 30, I think that's bullish for that whole global growth story. Just overwhelming amount of demand, no question about it. Let's talk about what's not working. Gold miners breaking down, continuing to break down, making new relative lows compared to the S&P 500, compared to the NASDAQ 100. Nobody wants these things, right? What was it? Mark Twain said that a gold miner, what is it? That a gold mine is a hole in the ground with a liar standing on top of it, right? The market's obviously proving that, right? Nobody wants these things. So I don't think we need to be the first ones in. I like how the boys put together a nice pun this week, how international markets, the international stock market is really bullish, right? I think it was the headline. So Israel coming out of a decade-long base, making new all-time highs. We talked about this last week. The technology exposure. South Korea, Taiwan, you're seeing China. Emerging markets are are not a natural resources play these days. There are a lot of technology. You know, the largest components of emerging markets are Taiwan Semi, Tencent, Alibaba, right? The opposite of natural resources. It's just not what they are. So the question really becomes, should we be spending our time looking for stocks to buy? Or should we be spending our time looking for stocks to sell? Like, that's a big question as far as I'm concerned. And we continue to focus our attention on looking for stocks to buy. That's how I'm seeing it. That could be a mistake. 6 months ago, that could have been a mistake. It was not. People were telling me that the market was frothy, that I was too complacent, that there was too much complacency in the market overall. They were telling me this in the summer. They were telling me that we were seeing a deterioration in breadth in the summer. They were telling me it was only 5 stocks driving this market in the summer. All of that was wrong. Right? When you look at the Google searches of people looking for bubbles, it's off the charts, right? If anything, if there's a bubble anywhere, it's in people looking for a bubble, right? So to me, the overwhelming evidence is that we should be looking for stocks to buy. That's where we should be spending our time, not looking for stocks to sell. Does it mean we need to buy every stock? No. Does it mean that we're not going to see corrections in certain sectors or stocks or industry groups or short interest names, right? Of course we're going to see those corrections. But that doesn't change the fact that we should probably continue to spend our time looking for stocks to buy, identifying stocks that offer favorable risk versus reward opportunities, right? We're seeing sector rotation. So some of the stuff that may have not been working in the fourth quarter could potentially be working now. We've seen that. We've continued to see that. To quote the great technical analyst Ralph Acampora, sector rotation is the lifeblood of a bull market. So, with that being said, let's take a look at an interesting universe of stocks. This is the Under the Hood report, just dropped this week, every other week. These are stocks that are showing an unusual increase in investor interest for whatever the reason. It might be insider transactions, could be unusually high volume, could be unusual options activity. But they're seeing it could be social media mentions as well, right? But for whatever reason, these stocks are seeing an unusual increase in investor interest. Does it mean that we need to buy it? Of course not. In fact, maybe we short them, right? Because this is a long short scan. In some cases, people are focused on a stock because they're ripping. In other cases, people are focused on the stock and they're too focused on it. And we probably want to fade them and take the other side. So what I like about this is that it's a nice long short sort of situation. So what are we looking at here? Vocera Communications, VCRA. So VCRA, last check, trading just below 45. It's still in the small cap space, has not graduated to mid cap. It's a $1.5 billion company. The bet we're making is that it's going to turn into a mid cap. Right? That's the bet that we're making. So it's a $1.5 billion company. It's a technology stock. It's in the technology sector. It's communications equipment, but it's in the technology sector, not in communications. I love the fact that relative strength is making new highs, right? I love the fact that the stock is breaking out to new highs. For me, it's pretty simple. If we're above 43, I like it long with a target of 59. If it's below 43, do we want to be long? No. I think you leave it alone. Why? Because it puts us back below those late 2018, early 2019 highs. And if we're below those levels, then we cannot make the argument that we are now breaking out of a base to new all-time highs. The argument would be the opposite, that, hey, we're still stuck below that former overhead supply, and I don't know how long it's going to take. But we are above those levels, so we can make that argument. If we break below that, the market would invalidate that thesis. We have to act accordingly and no longer be long the stock, right? That just makes sense. We're not here to be right. We're here to make money. And the way to do that consistently is by constantly skewing the risk versus reward in our favor. So if we're wrong here, what are we going to lose? A couple points? It's okay, right? It's happened before. It'll happen again. What if we're right? We'll make 7 to 8 times that risk. That's what I like. Big base, relative strength, positive momentum, new highs. It's the right sector. Stocks are in a bull market. The risk versus reward, most importantly, is skewed in our favor. Check, 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 right? So when we go back and look at this trade 6 months from now, 12 months from now, 10 years from now, tomorrow, whatever it is, and we look back and we can say, man, that didn't work. Would I have made that same trade again if I had the chance? And as long as you can say yes, regardless of the outcome, I think we can live with that. I think we can live with that. So if you want these slides, again, guys, email info@allstarcharts.com. And the password is bubble trouble. info@allstarcharts.com. Password bubble trouble. So let's take some questions. JC, it seems to me that the market is frothy, especially with GameStop. I don't know if that was a question or if that was a comment. Listen, stocks are going to get squeezed, right? These institutions have been doing it forever. We see it every day. It might not be making the headlines like it is today, but it happens quite often. In this case, it's the institutions getting squeezed by the retail investors, which I find to be hilarious, but that's not my problem. I'm not the one getting screwed here. So, as long as that's the case, I'm good with it. As long as it's other people getting screwed, I'm happy with it. It's part of it. And by the way, this under the hood report that we just dropped on Monday, there's a reason why we do that. We're looking for stocks showing an unusual increase in investor interest for whatever the reason. Chatter on the social message boards or whatever, social media, an increase in volume, et cetera, et cetera. The under the hood report flagged GameStop in September of last year, right? That's why we build these scans. That's why we do those reports. Did I know GameStop was going to do what it did over the past week? Of course not. Did the scan know? Was there a magic indicator to tell us? No. But we did know that there was an unusual increase in investor interest for whatever the reason. We now know why, but for whatever the reason, got on our radar, put a buy on it, and the rest, as they say, is history. So we're going to keep doing that, right? And these short squeezes are going to keep coming. And one day, maybe next week, maybe next month, maybe next year, they're going to stop being the headlines, right? What's funny is that the financial media these days is journalists reading to your parents what happened on Reddit that day and what happened on Twitter that day. Isn't that hilarious? That's what journalism is now, which I find hysterical, which is why we focus on price. Like, we don't need the gossip. We don't need bedtime stories, right? We're adults, right? Come on. We focus on price. We focus on the truth. We focus on facts. And price is truth. Price is fact. There's information there, right? And our scans pick it up. We see it common sense with our eyes. We see it. All right, we've got time for one more question. JC, Nancy Pelosi is YOLOing Tesla calls. Should that be illegal? I don't know. Maybe, right? Maybe it sounds like maybe they should be, if you're in a senator or, you're Congress or the president or, you're in the government somehow, I as a citizen, I would prefer that you be governing than day trading, Tesla calls, or, maybe not day trading. I think it was a Leap or something like that, or her and her husband or something like that. I'm not sure. But that's information. And number one, it's not my place to judge, right? I don't get a say in the matter. If those are the rules and she's playing by the rules and she's allowed to buy Tesla calls and she has to disclose it and she does and all of that stuff, then I have no problem with it. Go nuts. You can either complain about it or you could use that as information to take advantage of something that she knows about that we don't, obviously. If you want the slides, again, info@allstarcharts.com. Password bubble trouble. Info@allstarcharts.com. Password bubble trouble. Folks, my name is JC Parets. I am the founder of All Star Charts. Follow me on Twitter at All Star Charts, StockTwits, YouTube, Instagram at All Star Charts.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.